Welcome back to the deep dive. We're here to cut through the noise and really get you the key insights from the financial world. And today, September 16th, 2025, we've got a real puzzle on our hands. Seriously. Imagine this. You look at a company's financials, and it's not pretty. Cash burn, debt piling up, even a stark warning about its ability to, stay afloat. Then you glance over at the stock chart, and it's just defying gravity. It soared over 145% in one day. And the trading volume, it went through its entire public float like 70 times over. 70. So the big question for us today, the one we really need to unpack, is how do you square that financial reality with this insane market frenzy? Is this sudden surge in the market finally waking up to some hidden value? Or is it pure speculation, a momentum trade that's papering over some really deep operational cracks and a frankly precarious financial state? Because look, the current share price is way, way above even the most optimistic value estimates. It's like the market's betting on a perfect, flawless turnaround with zero room for error.
It's a fascinating situation, a classic clash between fundamentals and just pure market sentiment. And the gap couldn't be wider here. This deep dive today, it's not just about FGI Industries Ltd. It's really about giving you a framework, a way to understand the kind of forces that can drive these really dramatic, sometimes baffling market moves.
Exactly. So our mission is to unpack FGI Industries Ltd. Ticker FGI, looking at everything: their business, the management, the numbers, what the market thinks, who owns it, and crucially, the risks involved. We followed our detailed research protocol, trying to pull out the most important pieces of information for you, basically giving you a shortcut to getting properly informed on this very intriguing company. Let's dig in.
Okay, let's kick things off with Chapter 1, Business Analysis. So first things first, what is FGI Industries? What do they actually do? Right, so for like over 30 years, FGI has been a global B2B, so business-to-business supplier. Kitchen and bath products mainly. They're involved in the whole chain, designing stuff, sourcing it globally, and then distributing it to a pretty wide range of customers. Think big home center retailers, wholesalers, even e-commerce platforms now.
Okay, and I saw they have this kind of dual strategy with branding.
Yeah, that's pretty key. They supply private label products. Maybe you've seen Glacier Bay at the Home Depot. That's an example.
Ah, okay.
But they also push their own proprietary brands. The idea there is, to capture higher margins than just being a private label supplier.
Makes sense. And what kind of products are we talking about specifically?
They break it down into four main buckets. Sanitaryware, that's your toilets, sinks. The basics is actually their biggest revenue chunk. Then there's bath furniture, vanities, mirrors, that sort of thing. Shower systems, so walls, doors, basins. And then this last category they just call Other. Now, this one's interesting. It's small now, but it includes things like custom kitchen cabinetry. They have brands like Covered Bridge Cabinetry and Craft Plus Main in there.
Custom cabinetry sounds higher end.
Exactly. Management sees that as a potential high-margin, long-term growth area, a way to diversify maybe away from some of the more commoditized bath stuff.
Got it. So they've been around 30 plus years, built this reputation as a trusted supplier. But it's important to remember, right, before this crazy stock surge, they were tiny. A microcap, under $10 million market cap.
Absolutely tiny, which makes their position interesting. Their value proposition isn't really about consumer brand recognition. Nobody's asking for an FGI toilet by name. It's all about their B2B customers. They offer innovation, they have in-house design quality, and service. Essentially, they're promising a reliable global supply chain. They become an integrated partner for these big retailers.
Okay, integrated partner. And their fate is obviously tied to the housing market, specifically repairs and remodels.
Yeah, the residential R&R market. Historically, that grows maybe 3–5% a year. So FGI is tied to that cycle. And like everyone else, they've seen the huge shift to e-commerce. By 2021, something like 23% of their sales were online. So they're adapting there too.
What about competition? Must be pretty fierce.
Oh, it's intense and varied. In sanitaryware, you're talking global giants. But in bath furniture, it's way more fragmented, lots of smaller players. FGI competes mainly on price and their distribution network, especially against those smaller guys.
And it's not easy for someone new to just jump in and compete, is it? What are the barriers?
They're pretty high, actually. You've got significant regulatory costs.
Yeah.
Think EPA water sense rules for efficiency, CARB Phase 2 for wood product emissions. Stuff like that costs money. And honestly, just replicating FGI's supply chain and distribution network, that took them decades to build. That's a massive hurdle for a newcomer.
So what's their real edge then, if not brand recognition?
It's that B2B reputation, being seen as reliable, and they have this capital-light model. They outsource manufacturing.
Capital light sounds good. Flexible, less investment needed up front.
It is flexible, but, and this is a huge but,
Yeah.
it leads to extreme supplier concentration risk. Get this. 66.1% of their accounts payable was tied to one single supplier, Tangshan Huida Ceramic Group.
Wow, 66%. That's
Whoa.
precarious.
Hugely. If anything happens with Huida, FGI is in serious trouble. So that capital-light asset is also a massive potential liability. Also, for their big customers, switching away from FGI isn't trivial. There are moderate switching costs, so the relationships are somewhat sticky. And then there's the ownership structure. Their former parent, Foremost Groups Ltd, still owns 71.1%. This gives FGI sourcing access, which is good, but it also creates major governance risks we absolutely need to talk more about later.
Okay, definitely circling back to that ownership piece. Right, given those structural points, let's move on to Chapter 2, management evaluation. Because, even a decent business model can fall apart with the wrong leadership, especially in a crisis. FGI does have a seasoned team, right? CEO David Bruce has been in the industry over 20 years.
Yeah, experienced team, but boy, are they being tested right now. Big time.
How are they handling the current, crises? Plural.
Well, first, there's the 2025 tariff crisis. They're implementing what they call a China plus one strategy, trying to diversify their supply chain away from China. They apparently learned some lessons back in 2018 with the previous tariffs.
Okay, diversifying supply chains. That's sensible, if difficult. What else?
Here's where it gets really interesting and, frankly, concerning. There's a simultaneous financial viability crisis. Their Q2 2025 filings, the official documents, disclosed a bank covenant breach. Basically, they broke the rules of their loan agreement. And even more starkly, the filings included a warning about substantial doubt about going concern. That's auditor speak for, we're not sure this company can survive. A severe liquidity crisis.
Whoa, okay. Going concern warning.
Yeah.
That's serious. But wait, you said their public calls focused on growth?
Exactly, that's the disconnect. In their public earnings calls around the same time, management was mostly talking about growth initiatives, the BBC strategy we'll get to, and they actually maintained their full-year guidance, the severity of the liquidity risk, pretty much glossed over or omitted in those public statements.
So, let me get this straight. Publicly, it's growth, 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 but buried in the official filings, it's we might not survive. That feels problematic.
It raises serious questions about transparency, doesn't it? For you, the investor, listening to the earnings call, but maybe not digging through the SEC filings, you could get a very different, much rosier picture than reality. It really highlights the need to look at what companies do and file, not just what they say.
Okay, so transparency is a concern. How are they allocating capital amidst all this? Are they just trying to survive or still pushing that growth narrative?
Their stated strategy is still focused on organic growth. They call it BPC, brands, products, channels. This includes things like expanding into Europe and India. They've got a joint venture called Isla Porter, which is like a digital custom kitchen thing.
Right.
They also say they have an M&A strategy, but frankly, with their finances, there's been no recent activity there. Unsurprising.
Right.
But here's another critical action you need to know about. On July 31st, 2025, just weeks before those Q2 earnings revealed the covenant breach, they did a 1-for-5 reverse stock split.
A reverse split, consolidating shares to boost the price. Why then?
It looks like a purely defensive move to avoid being delisted from the stock exchange for having too low a share price. It wasn't about fundamentals. It screams financial distress. It's another signal that things were really bad even before the official warnings came out.
And all this ties back to their financial performance, specifically return on invested capital, ROIC.
Absolutely. Their TTM ROIC is deeply negative, somewhere between Minica 3.24% and Meta 5.57%. What that number tells you is that right now the company isn't generating value with the capital it has, it's actually destroying it. Makes all that talk about growth initiatives ring a bit hollow, doesn't it?
It really does. Okay, that leads us perfectly into Chapter 3, financial analysis. Let's dive into the numbers that are telling this. Well, this rather grim story. Market cap first. As we recorded this midday, it was fluctuating wildly, but around $18.7 million. Still firmly microcap territory, despite the surge. A tiny company, really.
Yeah, very small. Now, revenue. The long-term picture is pretty stagnant, only about 0.86% average growth over the last 5 years. However, more recently, their trailing 12-month, or TTM, revenue grew 12.3% to $135.9 million.
Okay, 12% growth sounds good.
On the surface, maybe, but here's the catch. That growth came at the direct expense of profitability. They bought revenue, essentially. It wasn't healthy bottom-line growth.
Right, and profitability, sounds like there isn't much.
Pretty much none. TTM gross margin is 26.24%, but that's actually shrinking because of the tariff squeezing them. Operating margin is negative 2.53%. Net margin is negative 2.27%.
Yeah.
It's just red ink across the board. They are not making money.
Which raises the big question, where's the cash going? Free cash flow.
The million-dollar question, or perhaps the negative million-dollar question here. The trend is alarming. Highly inconsistent and sharply negative free cash flow. TTM FCF was negative $1.67 million. That's not just a number on a page. That means the business itself is bleeding cash. It's burning through money just to operate. It fundamentally threatens its survival. Any investment right now isn't based on current health. It's a bet they can somehow stop the bleeding fast.
And earnings per share, also negative, I assume.
Yep. Highly inconsistent earnings historically, net losses recently. TTM earnings per share is a loss of $1.49.
So financially unstable, let's talk debt.
Right. Debt-to-equity ratio was 61.9% back in June 2025. And remember, that was with the breached loan covenant we mentioned, a serious default situation. Their current ratio, which measures short-term liquidity, can they pay their immediate bills, is pretty thin, only 1.21.
So high debt, breached covenant, low liquidity.
It paints a picture of what we can call a liquidity trap. Think about it. They're achieving double-digit revenue growth, right? Pouring water onto the garden. But that growth isn't translating into profit or, critically, cash flow. The water's just draining away. The soil is parched. With only $2.5 million in cash left and their main credit line breached, this growth is completely unsustainable. It actually accelerates the cash burn. Without new capital infusion, the risk of insolvency is very, very real.
Okay, a liquidity trap, that's a stark image. So valuation. Price to earnings is useless with negative earnings.
Completely useless. So we look elsewhere. Price to sales, PS, is very low, 0.14. Price to book, PB, is 0.92, just under book value.
Low ratios. Does that mean it's cheap?
It looks cheap, but those low multiples reflect the market pricing in significant distress and risk. Compared to a healthy, profitable peer like Masco, they traded a PE around 19.5. FGI's discount reflects the unprofitability and the high chance things could go badly wrong.
So relative valuation is skewed by distress. What about intrinsic value, discounted cash flow, DCF?
Doing a traditional DCF on FGI right now is, well, it's exceptionally difficult. Negative free cash flow, huge uncertainty about the future. Your assumptions become everything. So instead of a single point estimate, an educational scenario-based model makes more sense.
Okay, educational scenarios. Given the volatility, what do those look like?
Well, the bear case is pretty simple. The company doesn't make it. Equity value goes to roughly $0. A base case assumes they somehow stabilize, maybe muddle through. That might put the value around $4 per share. Then there's the bull case. This assumes a really successful turnaround. The China +1 works perfectly. They regain profitability. Maybe you get to around $7 per share.
$0 to $7. That's an incredibly wide range.
It highlights the extreme uncertainty.
Yeah.
And that valuation range is calculated using a very high discount rate, an 18% weighted average cost of capital, WACC. That high WACC reflects the massive risk investors are taking on here.
Right, so we have this picture of a company in a really tight financial spot, maybe even facing insolvency. But the stock price is just going absolutely ballistic. Which brings us neatly to Chapter 4, market sentiment, because clearly the market's perception is telling a very different story from the financials right now.
It's quite something. Look at the analysts covering the stock. You've got the stark division. Some analysts still have strong buy ratings out there, with price targets between $7 and $10. They're seeing significant upside, presumably betting heavily on that turnaround. But then, in sharp contrast, Zacks Investment Research slapped a strong sell downgrade on it back in August 2025.
Strong buy and strong sell at the same time.
Yep, polar opposites. And because of that downgrade, the average brokerage recommendation actually worsened significantly from a perfect 1.00, unanimous strong buy, to 2.33 in just 1 month. It shows how quickly sentiment can shift, or at least how divided it is.
And the recent news, Q2 earnings were kind of mixed, right? Revenue beat, EPS missed.
Yeah, technically mixed. But honestly, nobody cared about the earnings details. That news was completely swamped, just utterly overshadowed by the crazy stock surge on September 16th. Remember, it jumped over 214% in pre-market trading that day. That move wasn't driven by fundamentals or earnings news. It was pure momentum. The market just seemed to ignore the balance sheet problems entirely.
So what is driving it then, if not fundamentals?
Good question. One factor could be the short interest. It's significant, at 5.76% of the public float. Now, the public float itself is tiny, only about 521,000 shares. So that 5.76% isn't a huge number of shares in absolute terms, but relative to the available shares, it makes FGI highly susceptible to a short squeeze.
Ah, the short squeeze, where buying pressure forces short sellers to cover their positions, driving the price up even further.
Exactly. That could certainly be part of the explanation for the insane volume we saw. Remember, 70 times the float traded hands?
Yeah.
That suggests a lot of frantic covering and speculative buying. And look where the price is now, $9.73 as we record. That is dramatically above both the 50-day moving average, $4.05, and the 200-day moving average, $3.85.
Way above the averages.
Completely detached. It screams short-term, unsustainable, bullish momentum, fueled by speculation, not underlying value. It's like that game of musical chairs everyone's dancing while the music plays, but you really don't want to be left standing when it stops.
So we're seeing this incredible disconnect. You could call it cognitive dissonance in the market, right? The fundamental picture is grim distress, cash burn, warnings. But the market sentiment is euphoric, speculative. The price seems totally untethered from the business reality. That stat about the float trading 70 times over, that's not investing behavior, is it? That's pure speculation. With all that volatility and speculation swirling around, the question of who actually owns this company becomes even more critical. So let's move to Chapter 5, ownership structure. Because who's holding the shares can really influence the future, especially when a company is under pressure. First glance, institutional ownership seems really low.
Exceptionally low, only 6.5%, and that's spread across just 9 institutions. The biggest holder is First Wilshire with 5.79%. Vanguard is a tiny position, 0.26%. What this tells you is there's a real lack of validation from the big professional money managers.
Okay.
They're largely staying away.
Okay, institutions aren't buying in. What about insiders?
Yeah.
Management.
So very low. Direct insider ownership is only 1.75%. And maybe more telling, there have been zero open market purchases or sales by insiders in the last 12 months.
No buying, no selling either.
Correct. You could interpret the lack of buying as, well, maybe a lack of confidence in the turnaround for the people who know the company best. The lack of selling might be due to restrictions or optics, but the lack of buying is notable.
Right, but there's a bigger ownership story here, isn't there? The former parent company.
Oh, yes. This is the really important detail. The ownership structure is dominated by extreme concentration. Foremost Groups Ltd, FGI's former parent company, still owns a massive 71.1% of the shares.
71%. So FGI is basically a controlled company.
Precisely. That's the technical term, and it has huge implications.
Okay, explain that. What does controlled company mean for an everyday investor, for you listening right now?
It means Foremost essentially has unilateral control. They hold the majority of the votes, they can dictate strategic decisions, they control board elections, they can approve or reject mergers, and crucially, they can heavily influence agreements between FGI and Foremost itself, things like transfer pricing for sourcing.
So minority shareholders, like someone buying the stock today, they basically have no say.
Pretty much. Your vote is irrelevant when one entity holds 71%. It's like being a tiny shareholder in a family business, where the family makes all the decisions behind closed doors. This creates significant and permanent potential for conflicts of interest. Foremost's interests might not align with the interests of minority shareholders. They could make decisions that benefit Foremost, even if it harms FGI or its public investors.
And there's no real way for minority shareholders to fight that.
Very little recourse. This isn't just a temporary risk factor. It's baked into the structure of the company as long as Foremost holds that controlling stake. It's a fundamental governance risk you have to accept if you invest in FGI.
Okay, that concentrated ownership combined with the financial distress we talked about, it all funnels into risk. So let's explicitly address that in Chapter 6, risk assessment. We can use the SWOT framework here, right? Strengths, weaknesses, opportunities, threats. Helps organize the thinking.
Yeah, it's a useful tool here. So strengths for FGI, they do have them. Those deep, long-standing customer relationships with big retailers are valuable. They have an experienced management team, even if they're under fire now. And they have that established global supply chain, warts and all.
Yeah.
Those are real assets.
Okay, assets on one side. What about the weaknesses? Sounds like they're pretty significant.
Oh, they are profound. First and foremost, the extreme financial fragility. The risk of insolvency is real, driven by cash burn and that breached covenant. Then there's the critical supplier concentration we highlighted, that 66% dependence on Huida is a massive weak point. And finally, the controlled company governance risks we just discussed. Minority shareholders have very little power. Those are huge weaknesses.
Right. Now, opportunities. What potential positives are out there if things go right?
The main one is the China Plus One strategic pivot. If they can successfully diversify their supply chain away from China, reduce tariff impacts, and maybe find lower costs elsewhere, that could strengthen the company long term. There's also geographic expansion. They're looking at Europe and India. And that push into higher margin products like custom kitchen cabinetry could improve profitability down the line.
So potential upsides exist, but what about the threats, the external dangers?
Threats are also significant and maybe more immediate. Intense competition isn't going away. High customer concentration is a big one. They rely heavily on a few large customers.
Right.
Losing the Home Depot, for instance, would be absolutely devastating. You've got broader macroeconomic headwinds, rising interest rates, potential slowdown that could hurt the R&R market, and specifically those 2025 U.S.-imposed tariffs. They are a direct threat right now, actively compressing gross margins and forcing this costly, risky supply chain overhaul.
Okay, so when you put it all together, SWOT, what's the key dynamic we should take away?
The critical dynamic, the connection that jumps out, is this. The tariffs a major threat are the direct catalyst forcing the China plus one diversification, a key opportunity. What this means is that investing in FGI right now isn't just a bet on the existing business. It's a high-risk, high-reward bet, specifically on management's ability to execute this crisis-driven transformation while teetering on the financial edge.
So it's a bet on reinvention forced by external pressure under extreme duress.
Exactly. It's not business as usual. It's a bet on navigating a perfect storm.
All right, let's bring this all home with Chapter 7. Conclusion. We've covered a lot of ground. If you had to summarize the bull case for FGI, looking past the current storm clouds, what would it be?
Okay, the bull argument, stripped down, relies on a few things. One, you bet on the experienced management team to navigate this crisis successfully. Two, you point to the recent revenue growth from those BPC initiatives as a sign of life. Three, you believe the China plus one pivot will ultimately create a stronger, more resilient company. And four, you argue the super low PS and PB ratios signal deep undervaluation if, and it's a massive if, they return to profitability and execute flawlessly. A lot of ifs in there. Now, the bear case. Sounds like it writes itself at this point. The bear case is formidable and, frankly, much more grounded in current reality. You start with the severe financial distress, the breached covenant, the going concern warning, the real risk of insolvency. Add the persistent cash burn, the immense execution risk involved in rapidly overhauling a global supply chain under pressure. Throw in the problematic controlled company governance structure where minority shareholders are along for the ride whether they like it or not. And then cap it off with a stock price that appears completely disconnected from these grim fundamentals, driven by what looks like pure speculative momentum.
And our educational DCF model, that valuation range was incredibly wide, $0 to $7 per share.
Yeah, that range itself just screams extreme uncertainty. The company's actual value is totally dependent on a successful turnaround, which is very, very far from guaranteed. It highlights how sensitive any valuation is to assumptions right now.
So the final thought here, the provocative takeaway for you, our listener.
It's this. FGI's current share price, around $9.73 when we looked, is trading significantly above even the high end, the most optimistic scenario of our estimated intrinsic value range, $7. What does that disparity tell you? It suggests the market, in its current frenzy, has priced in a near-perfect, flawless execution of this incredibly difficult turnaround. It's baked in the miracle already. There seems to be absolutely no margin of safety left for the very real operational risks, the financial fragility, the governance issues we've discussed. It's a bet on perfection, with almost no cushions if anything goes wrong. So what stands out to you after this deep dive?
Wow, so FGI Industries, a company fighting for its life, caught in the middle of a wild market storm, a situation where the numbers and the narrative are just pulling in completely opposite directions. It's an extraordinary dilemma for anyone looking at this stock. Well, if you found this deep dive insightful, please do like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. And remember, our $4.99 a month members get priority on deep dives for tickers they request. Plus, big news. Over the next few months, we're tackling all of the S&P 500 stocks, and members get exclusive priority access to those deep dives. If you just want a one-off deep dive on a specific stock that's caught your eye, you can always drop us a super thanks on the video.
And the usual reminder, this analysis was generated by an AI system. It's for educational purposes only and should definitely not be taken as financial advice. Please always do your own research or talk to a qualified financial advisor before making any investment decisions.